Imagine entering retirement with a $1,600 mortgage payment and enough savings to erase it tomorrow. Paying off the house would remove $19,200 of annual payments. It might also take $200,000 out of the accounts meant to support everything else. So which choice is safer? Paying off the mortgage can be one of the calmest moves you make before retirement, but only when it does not leave you house rich and cash poor. The decision comes down to three things: the payment you remove, the reserve you have left, and the risk you are trying to escape. The last one matters more than the interest rate comparison most people begin with. Start with the payment. A mortgage statement often combines several different bills. Principal and interest repay the loan. An escrow account may collect property taxes and homeowners insurance. Paying off the mortgage removes the principal and interest. It does not make the taxes, insurance, utilities, maintenance, or homeowners association bill disappear. That distinction sounds obvious until someone says, "My housing cost will drop from $2,100 to zero." It probably will not. The better calculation is the exact amount of required monthly cash flow that truly disappears after the loan is gone. Suppose $1,600 of a $2,100 payment is principal and interest. Eliminating it reduces the household's annual income need by $19,200. That can lower portfolio withdrawals, make Social Security and pension income cover more of the basics, and remove one large bill that arrives whether the market is up or down. For a retiree, that predictability has real value. A household that needs $60,000 a year from all income sources is in a different position from one that needs $40,800 after the mortgage disappears. But do not count the whole payment as savings until you separate the pieces. Property taxes can rise. Insurance premiums can change. A paid-off house still needs a roof, a furnace, plumbing, paint, and eventually appliances. A paid-off mortgage does not create a free house. It creates a house without one particular bill. There is also a difference between reducing a payment and shortening a loan. Sending extra principal may save interest and move the payoff date closer, but it may not lower the required monthly payment unless the loan is formally changed. If the goal is lower retirement cash flow, confirm what action actually changes the monthly obligation instead of assuming every extra dollar does. For someone still working, the answer may be gradual rather than dramatic. Directing raises, bonuses, or a fixed extra amount toward principal can bring the balance down while preserving liquidity. The final decision can then be made with a smaller payoff amount and a clearer view of retirement income. Now look at the reserve. This is where the emotionally satisfying choice can become financially dangerous. A person may use nearly every liquid dollar to pay off the loan and feel wonderfully debt-free on Monday. Then the car fails on Friday. The home may be worth $500,000, but a bedroom wall cannot pay a dental bill. Net worth and spendable money are not the same thing. Before paying off the mortgage, calculate what remains after the check clears. Is there still a real emergency reserve? Is there money for a major home repair? Can the household cover several months of ordinary spending without selling investments during a bad market? Is the next vehicle already funded, or will it become a new loan 2 years later? The source of the payoff matters too. Using cash in a bank account is different from taking a large distribution from a traditional IRA or 401k. Traditional retirement plan distributions are generally taxable. A large withdrawal can create a larger tax bill, and higher income can also affect Medicare premiums in a later year. That does not mean retirement accounts should never be used. It means the amount withdrawn may need to be larger than the mortgage balance to leave enough after taxes, and the timing should be reviewed before one clean balance creates two messy surprises. Selling investments in a taxable account can have tax consequences as well. And if paying off the loan would consume most of the household's accessible investments, the plan has exchanged a monthly obligation for a liquidity problem. The safer version leaves three reserves intact: ordinary emergency cash, money for known large replacements, and enough invested assets to support the retirement income plan. If those reserves vanish, the mortgage may be gone, while financial flexibility disappears with it. Couples often feel this trade-off differently. One spouse sees debt as a threat and imagines the relief of owning the home outright. The other sees the investment account shrinking and imagines every future emergency. Neither fear is foolish. The decision should make both risks visible instead of allowing the louder fear to win. A useful compromise is to separate the payoff money from the rest of the portfolio for several months before making the decision. Live as though that money is unavailable. If the household still has enough reserve and the reduced mortgage burden clearly improves the plan, the payoff becomes easier to defend. If the missing liquidity immediately feels dangerous, that is information too. Now we reach the third part, risk. Most comparisons begin with the mortgage rate versus an expected investment return. If the loan costs 3% and the portfolio might earn more, keeping the mortgage can look mathematically superior. If the loan costs 7%, paying it off may look obvious. That comparison is useful. It is not the whole decision. The return comparison should also be fair. Paying off a 5% mortgage produces a certain 5% interest saving before considering any tax effect. A portfolio return is uncertain, may be taxable, and may arrive only after several bad years. Comparing a guaranteed saving with an optimistic market average can make the investment side look more precise than it really is. On the other hand, a very low fixed rate can become easier to carry as prices and income rise over time. Paying it off may sacrifice flexibility to eliminate a payment that the household can already support comfortably. The rate matters, but the household's ability to absorb surprises matters more. Investment returns are uncertain and arrive unevenly. The mortgage payment is certain and arrives every month. A portfolio can average a healthy return over 20 years while falling sharply during the first year of retirement, exactly when withdrawals begin. When a large mortgage payment must still be funded during that decline, the retiree may have to sell more shares at low prices. Removing the payment reduces the amount the portfolio is forced to produce during bad years. That is why the true value of paying off a mortgage is not simply the interest saved. It is the number of future withdrawals that become optional. But keeping the mortgage can protect against a different risk. It keeps more cash and investments available. That money can cover emergencies, earn returns, or prevent the retiree from borrowing against the house later under worse terms. The decision is therefore not risk versus no risk. It is fixed payment risk versus liquidity and opportunity risk. Here is the midpoint test. If you are close to retirement, do not ask what a generic homeowner should do. Ask which problem could actually break your household. Would a market decline plus a large mortgage payment force uncomfortable withdrawals? Would an empty reserve plus a paid-off home force you to borrow again? Would either choice require you to delay retirement? Would one choice allow you to sleep while the other keeps you checking the market every morning? Consider two households. The first has a $140,000 mortgage at a moderate rate, a large monthly payment, reliable pension income, and enough savings to pay off the loan while still keeping several years of spending and repair money. For them, eliminating the mortgage may create a much sturdier retirement. The second has a small, low-rate mortgage, no pension, and most of its wealth inside a traditional retirement account. Paying off the loan would require a large taxable withdrawal and leave very little accessible money. For them, keeping the mortgage may be the safer choice, even if being debt-free sounds better. The same mortgage balance can produce opposite answers because the household around it is different. There is also a third household that should not rush either way. The mortgage is manageable, retirement is still several years away, and the emergency reserve is not yet strong. That household may be better served by building cash, increasing retirement contributions, and making modest extra principal payments rather than forcing an all-or-nothing decision today. A good retirement choice does not need to be made early merely to feel decisive. It needs to be made when the numbers, taxes, and reserves are visible. There is also a tax myth worth clearing away. Mortgage interest can be deductible only when the household qualifies and itemizes deductions. A deduction reduces taxable income. It does not turn $1 of interest into $1 of profit. Do not keep an unnecessary loan merely to preserve a deduction you may not use or that returns only part of the interest paid. At the same time, do not empty a healthy portfolio just because debt feels morally untidy. Retirement decisions should protect the household, not win an argument with a balance sheet. So make the decision on one page. First, write down the exact principal and interest payment that disappears. Keep taxes, insurance, utilities, and maintenance in the retirement budget. Second, list what remains after payoff: emergency cash, repair reserves, investments, and reliable monthly income. Include the tax cost if the money must come from a retirement account or appreciated investments. Third, stress test both versions. In one column, keep the mortgage through a bad market and a major repair. In the other, pay it off and face the same repair with a smaller liquid reserve. The safer column is not always the one with the higher projected net worth. It is the one that can absorb bad timing without forcing a desperate decision. For some retirees, that means writing the final mortgage check before the final work paycheck. For others, it means keeping a cheap loan and protecting the cash that makes retirement flexible. In the comments, tell me which would give you more peace in retirement: no mortgage or a larger cash and investment reserve. Paying off the mortgage can remove one of retirement's largest monthly bills, but it does not make the house free, and it does not stop the other expenses that arrive after the paycheck disappears. Next, we are looking at 5 retirement costs people consistently underestimate, including the hidden problem that makes several manageable bills dangerous when they land in the same year. A safe retirement is not the one with the cleanest balance sheet. It is the one that keeps its choices.